Okay, so imagine this. A huge company with billions of dollars in debt that you just couldn't see. For decades, this was totally normal. Companies could lease everything, planes, buildings, entire fleets of trucks, and those massive financial promises were basically invisible on their main books. It was a world of hidden debt. And then a new accounting rule called IFRS 16 came along and, well, it flipped on the lights.
So how did this one rule change pretty much everything? Well, that's what we're going to break down. We'll start with why this hidden debt was such a problem. Then we'll get into what actually counts as a lease now. After that, we'll look at the new rules for renters, then flip it and see it from the owner's side. And finally, we'll zoom out and look at the big picture impact.
All right, let's dive right into the core issue, the hidden debt problem. You see, to really get why the new rule is so important, we have to understand just how big of a deal the old way of doing things was.
I mean, just think about an airline for a second. Its most important assets are its planes, right? But what if it didn't actually own a single one? Before IFRS 16, that airline could lease its entire fleet. We're talking a multi-billion-dollar commitment, and that huge obligation wouldn't even show up as debt on its balance sheet. If you were an investor trying to figure out the real risk of that company, it was like you were flying with a giant blind spot. So here's the change in a nutshell. On the left, you've got the old rules. A massive commitment like leasing a skyscraper was basically just treated like your monthly internet bill, just an expense. But the new rules, they pull back the curtain. Now, as you see on the right, the company has to show both things, the valuable right to use that building and the giant liability it took on to get it. The most important thing to get here is that IFRS 16 didn't create new debt. It just forced companies to finally show the debt that was there all along.
Okay, so if the whole point is to get all these hidden promises onto the books, the first step is pretty obvious, right? You need a really clear definition of what a lease even is.
The official definition here might look a little technical, but honestly, it all boils down to two key ideas: control and an identified asset. It basically means it's not enough to just pay for the use of something. The contract has to give you control over a specific thing. That idea of control, that's the new magic word.
So, how do you know if you have control? Well, the rule gives us these three key tests. First, is there an identified asset? You're not just renting a car, you're renting that car with that specific VIN number. Second, do you get the economic benefits? If you use that car for deliveries and make money, does that money go to you? And third, and this is the big one, do you direct its use? Are you the one saying where it goes and what it's used for? If you can answer yes to all three, then boom, you've got yourself a lease.
And this brings us to the folks who were most affected by all this, the lessee. That's just the fancy term for the company or person who's actually renting the asset. For them, the world really did change overnight.
So what does this new rulebook actually make them do? It all comes down to this one core principle. For pretty much every lease out there, the renter has to add two brand new things to their balance sheet, something called a right-of-use asset and a lease liability. This is the fundamental change.
Let's think of it like a balancing scale. On one side, you've got the right-of-use asset. This is what you get, the economic benefit of using that warehouse or that fleet of vehicles. And on the other side, perfectly balancing it out, is the lease liability. This is what you owe, the total debt you've agreed to pay for that right. Before, you only saw the monthly payment. Now you see the full story, the asset you control and the debt you took on to get it.
And figuring out that liability isn't as simple as just, multiplying your rent by the number of months. You've got to pack a lot more into that number. Of course, it includes your fixed payments, but it also has to account for things like payments that might go up with inflation, any guarantees you've made about the asset's future value, and even the price to buy the thing at the end if you're probably going to. It's the whole shebang, your total true commitment.
Okay, so we've spent a lot of time on the renter's world, but what about the other side of the deal, the owner or the lessor? Well, for them, the new rules were much less of an earthquake. Their accounting actually stayed pretty similar to the way it was before.
For the owner, the big job is to classify the lease into one of two buckets. On the one hand, is it a finance lease? You can think of this as basically a sale in disguise. It's where the renter takes on almost all the risks and rewards, like being on the hook for all the maintenance. Or is it an operating lease? This is more like a true, simple rental where the owner still holds most of that risk. That one decision, finance or operating, drives all the accounting that comes after.
So, let's wrap this up by looking at a couple of practical details and the final impact of all this. Because, the rule makers didn't want companies getting bogged down tracking every single coffee machine rental. So they built in a couple of common sense exceptions.
Basically, companies can choose to ignore all these new complex rules for two specific kinds of leases. First, any short-term leases, so anything that lasts 12 months or less. And second, leases for low-value items. We're talking about the small stuff, laptops, office phones, furniture. For these little things, a company can just go back to the old, simple way of doing things and just record the rent as an expense.
So when you put it all together, what's the big takeaway? IFRS 16 was a massive leap forward for financial transparency. It took literally trillions of dollars of these hidden obligations that were buried deep in the footnotes of financial reports and dragged them right out into the open, onto the main balance sheet. The result is a much clearer, much more honest picture of a company's real financial position.
You see, this was never just about moving numbers around. It's a revolution in transparency. It fundamentally changes how we all analyze a company's debt and its risk. So the real question for every investor, for every analyst, for all of us, is this. Now that you can finally see the debts that were once hidden, how does that change the way you look at a company?